We're rolling.
Welcome to the House Dudes podcast, where we invite you to follow us on our journey towards financial freedom using the power of real estate. I'm Jack Haas.
And I'm Josh Koth. Here at House Dudes, we believe in a couple key principles. Number one, the best way to retain information is by teaching it to others. And number two, a rising tide lifts all boats. We're not competitors, we're a community. So let's get into some real estate investing.
Well, we have kind of a different topic here tonight that we haven't talked about in quite a while, and we have Josh Plave, who is an expert in self-directed retirement accounts. But Josh, you really have some other interesting background that has been different from some of our other guests who have talked about self-directing IRA, because you've also done some multifamily syndications that I think we're going to kind of deep dive into here as well. But I really appreciate you being on the show and kind of talking us through some of this and getting into the weeds.
Yeah, thanks so much for having me, Jack. I love getting into the weeds here.
So before we start things off, I want to make sure that everybody has your contact information, because sometimes we kind of get really into this and the conversation rolls, and I want to make sure that everybody has a way to get a hold of you. So make sure everybody bookmarks wall2main.com. That's WALLTOMAIN.com to get some of the information there. But where else can they find you?
Yeah, you can find me at josh@wall2main.com on Facebook, Instagram, and you can even call me at 240-620-3380. Well,
that is very brave to give out a phone number. I'm just going to warn you.
I'm always happy to talk to investors about their current situation.
So, well, we're gonna start with a very generic, broad topic and put you on the spot. So, first of all, we have a lot of newer listeners that listen to this show, and they're going to ask themselves, "What is a self-directed IRA?"
Yeah, so it's once you kind of learn about it, it's actually fairly simple. Essentially, many people have an IRA or a 401k, and the way it's currently held is at a custodian. It's at a Schwab, Vanguard, Fidelity type of a place. And what those type of custodians do, they're set up to trade with equities in stocks, bonds, mutual funds, things like that. And all a self-directed IRA is it's a fancy way to say it's at a different custodian, allowing you to invest in things that aren't stocks, bonds, and mutual funds. You can invest in really anything you'd like. There's very little restriction on it. You just can't invest in things like collectibles, like art, jewelry, or cars, in life insurance, or in shares in S corporations. So it's just a different vehicle that allows you to invest in real estate, gold, and crypto, things like that.
Sure. So when you're investing in real estate, for example, are there any restrictions or requirements associated with that type of transaction?
Yeah. So there are things. There's two different topics that we should talk about. We'll talk about prohibited transactions. So when it comes to a retirement account, I like to think of it like it's a totally different person. And what I mean by that is that you really can't have any interaction with your retirement account. So if I was to buy a rental property, I couldn't go rent from it. I couldn't live in that property. You can't buy a vacation house and occasionally visit it, even if it's for free, because you're gaining some direct benefit from the actions of your retirement account. So you can't gain any benefits of what your retirement account is able to get into. And then your retirement account can't actually gain any benefit from you as well. So you can't actively be involved. Let's say you purchase a property that needs to be flipped. You can't actually go in and swing a hammer. That's called sweat equity. You can't apply any of your own expertise or construction experience into it. You can GC it. You can actively, manage the property, but you can't actually work on it yourself and provide any experience that way. So as long as other people are working on it and you're kind of just supplying the funds, that's fine. And the other situation we need to talk about is disqualified persons. These are people that your retirement account can't actually do any kind of investing with. And so a disqualified person would be anyone who's a linear ascendant or descendant. And what this means is your parents and your grandparents going up, and then down, that means your children and your grandchildren. This also includes spouses at any level. So your own spouse, your children's spouse, your son-in-law, daughter-in-law, things like that. Brothers and sisters are all right. Aunts, uncles, and cousins are perfectly fine. So it's pretty restrictive. If you get involved in a transaction with any of these people, you need to try to wind back the transaction within the calendar year. And that includes a 15% penalty. And if you don't, it actually totally nullifies the entire retirement account. So you need to be very careful about the kind of transactions you get involved in. Luckily, though, there is a nice kind of creative way to get around the disqualified person situation, since, let's face it, the majority of people that many of us want to invest with would be family members, close people that are people that are close to us. So what you can actually do is you can pool retirement funds together. So let's say that me and my wife both want to get involved in an investment together. I can't put in my retirement account while she puts in cash funds. But as long as we're both investing with retirement funds, you can actually mix those together because they're essentially different people. My spouse, she is a disqualified person, but her retirement account is not. It's a totally separate entity. So this is actually what I've done with my family. My sisters and I, we all have different retirement accounts. And so we've actually pooled them together so that we can invest in larger amounts together. We can meet investment minimums for commercial syndications. We can kind of all put in a less amount of money individually and still meet a minimum investment.
That is a different strategy than we've heard in the past, that concept. So based on what you've said there, are there any additional benefits that, like when you're pooling your money like that?
So when it comes to direct benefits, it's essentially just being able to invest with people that you typically cannot get involved with. I know, I have a larger, because I opened my first Roth IRA when I was 16 years old. So I've actually gotten it to a point where it's fairly large for my age. I'm only 30. But my spouse, she started a little later. So she wouldn't be able to actually get involved in investing with her retirement account just yet because it's a newer account. It's under $15,000, $20,000. So by pooling together, I can actually start to grow her retirement account at a faster rate than I typically would be able to because I'm using the power and leverage of myself and my sisters as well if we are able to combine accounts. And like I mentioned earlier, I do multifamily syndications, and the typical minimum investment in a syndication would be somewhere between, let's say, $50,000 and $75,000. So when I've invested with my sisters, I have two sisters, and so we each supply $25,000, and so it doesn't take as much of a hit every time that we go to invest, but we're actually able to diversify even more broadly because we can get into more deals at a lower rate on an individual level.
Mm-hmm. So, well, let's go to that where people are going to be asking themselves now that they basically have most of their retirement money locked in an existing account, whether it's IRA or 401ks. Is there a way for those people to participate in what you're talking about?
Yeah, so we'll categorize this into two different categories. The first and easiest one is with an old 401k or an old IRA from a past employer. This is either held at your past employer in their current administrator, and you just need to ask for control of it and roll it over to a new account, or it's you have control over it. And at that point, it's very easy to open up a self-directed account and transfer the funds over. On the other side of things, if you have your funds still with the majority of your funds with an employer that you're currently with, that's a little trickier. You need to have the account in your control to be able to do a self-directed rollover. So what needs to happen is your plan needs to actually allow for what's called an in-service rollover. Now, unfortunately, a lot of plans actually don't allow for an in-service rollover. So a lot of the times for people like this, it's not necessarily possible. But the nice thing is certain plans allow for it, as well as if you are closer to retirement age. I've seen that many investors who are like 55 and over, some of the plans are structured that they start to allow for them to do in-service rollovers and take more control of their dollars. So that's nice. The nice thing is for 2020, we have a little bit of a change. The CARES Act actually came out and applied some changes directly for retirement accounts. What they did was they created this thing called the coronavirus related distribution. And so this was actually modeled after the Hurricane Katrina provisions that they created a few years ago. And so what you can do is, if you feel that you have been adversely affected by coronavirus, and you can declare what's called a coronavirus related distribution. And so if this is, if your money is held at a current employer's 401k, you can take out up to $100,000 from that 401k and declare it as a coronavirus related distribution. And when it's out of the account, you can do one of two things. The first one is you can actually just take it as income, and you don't have to have it in a retirement account anymore. And that income, the nice thing is you don't have the early withdrawal penalty fee. There's usually, I believe, a 15% early withdrawal penalty fee. And then you split it up over 3 years. So the income tax, let's say if the income tax is supposed to be $30,000, you actually pay 10 in 2020, 2021, and 2022. The other thing that you can do when you have the money is you can actually move it over into another qualified retirement plan. And that includes things like IRAs, a solo 401k you've established, any other plan that you have. And it doesn't have to be established before you do this. You can establish it after you have the money. You don't end up paying any early penalty fee. You don't end up paying any income tax. And it's essentially a way for you to take money from your employer-sponsored 401k plan and move it over into a plan that you now control. Previously, you wouldn't have actually had any ability to touch that money. Now, the only downside to this program that I'm finding with many investors is that the employer actually has to opt in. And so we're finding that many employers aren't opting in. It's worth giving your employer a call, checking with the administrator. A lot of their cheaper rates that they're able to provide for their funds come from, establishing a 401k of a certain size, but across the entire employer. So they don't really want to give up a lot of the funds that are held with them, but some are opting in and allowing their employees to take advantage of this.
Mm-hmm. So, we're going to just jump back just one subject matter there. You were talking about pooling your money with some of your siblings. For that matter, I guess it doesn't have to be those siblings. Is there do you have to create some sort of entity then that you're investing together in, or how does that process work? Yeah.
So it really depends on what kind of investment you're doing. We did pool our funds together in a holding company. When you establish, I'm a huge advocate for checkbook controlled IRAs. And so what that essentially is you open up a self-directed retirement account at a new custodian that supports, say, real estate. And then you also at the same time open up an LLC. And so the LLC ends up being the only investment that the IRA actually makes. So it buys 100% of the shares of that LLC. The nice thing now is that you actually have direct control over that LLC. You're the manager of that LLC, and you can choose the investments that it makes. And it's really quick. It's cheap to establish. It's the annual fees range between $125 and $180. So the overhead to maintain is very low, but you now have direct control over it, and you can just open up a normal checkbook account, or checking account, and you can have direct wire control. So what we did was we each have one of these LLCs established. So we have a couple of different ones, and then we created one large holding company, and we dumped all of those together into that holding company so that we can all kind of keep track of, and we keep track of who owns what percentage of the entire holding company, and then we keep track of what investments we're making, and we're able to kind of work our way forwards into the investment. And then when income comes back in, we can work it backwards into those original IRA accounts.
Sure. Well, you open the door now because we've heard that term checkbook control a few times. We're gonna jump now into some other terms that kind of float around what you're talking about. Yeah. One of them is UDFI. What is that?
Yeah. So let's say this comes up when you're investing in leveraged asset classes, we'll say. And so I am a multifamily syndicator. And so what we do is, a group of folks come together and we buy, I'll say 30, 40 people come together. We buy a large apartment building. And obviously you're going to do that with a bank. You're going to bring in leverage from outside of your retirement account. So when the IRA was created back in like the 60s, they wanted to incentivize you to use tax-deferred dollars. When you're bringing in leverage, and you're allowed to bring in leverage, you have to use what's called non-recourse loans. And this is why I think that commercial properties are actually really well tuned to retirement accounts, because they require non-recourse loans, and commercial properties almost exclusively use non-recourse loans. So they kind of just go hand in hand. But when you do invest in a multifamily property and there's outside funds coming in from a bank, the IRS is okay with that. But because they're non-tax deferred dollars, any income that is derived based off of those non-tax deferred dollars, you end up having to pay what's called UDFI. And this means unrelated debt financed income. So the unrelated is it's the bank's money. It's not related to your IRA. And so what happens is, let's say you buy a property for 75% leverage, 25% down payment. What happens in the first year is that 75% of the income that comes in from the property into your IRA is considered UDFI. And so you need to pay taxes on it. And the tax is called UBIT, Unrelated Business Income Tax. But the nice thing is, because that portion that's getting taxed is somebody else's money, that somebody else's money can actually make use of depreciation and operating expenses and any other losses that come with the property. So there's kind of a misconception a lot of the times with IRAs that they can't use depreciation. They can make use of it, not entirely all of it, but you can use, if it's 75% leverage for the current year, you can use approximately 75% of all of the losses, which helps offset things. So what I did was, a lot of people say, UBIT, if you invest in a leveraged property, UBIT's going to really blow up your returns. It's going to really harm and damage what you're doing. And so I got really tired of people kind of giving these vague, ominous warnings about the investments that you can make in a leveraged property. And so I went ahead and I actually built a UBIT calculator. And what this has shown is that because you're using depreciation and operating expenses and other losses, most multifamily properties last for about 5 years. And so for the first, let's say 3 to 4, it really depends on the makeup of the property, but very consistently in the first 3 to 4 years, you don't actually end up paying any UBIT on cash flow. It's a small amount that you're getting from cash flow, and so it's offset entirely by those losses. What you end up having to pay in a more substantial amount is on the capital gains. And so the nice thing is, if there aren't really any capital gains, you're not really paying any taxes. The more capital gains there are, the more taxes you end up paying. And so on a typical multifamily property, if over 5 years, let's say it's able to return 20% annually, we're seeing essentially about a 3 to 4% reduction annually in returns. And so in that last year, you do have to pay a fairly substantial amount. And that, I just want to clarify, that amount comes out of the capital gains. So you don't really have to pay it yourself. You don't have to have any kind of like dry gunpowder sitting on the side. But when you do have capital gains come in, you do have to pay a more sizable amount on the gains. But let's say if it's a 20% return, it brings it down to somewhere between a 16 and a 17% return annually. So if you think that's still a good return, it's worth your while. If you think that you kind of don't want to deal with it and you want to go into a more passive avenue, that's, it's fine too. But I was happy that I was able to kind of come up with that solution and see exactly what happens in a leveraged asset. And so when I come up with a new opportunity, whenever I find a new opportunity, I provide my investors with the UBIT calculator. So not only do they get the projected earnings, but they also get the projected taxes for a retirement account as well.
Sure. So if somebody was interested in finding that calculator, because I know that's what people are going to be looking for if they hear this episode, is that something you could maybe share?
Yeah. So on my website, on the header, one of the sections is a UBIT calculator, and I run you through what the calculator looks like. It's an Excel spreadsheet essentially, and so it's stick with me. There's a lot of numbers and lines in there, but everything has its place, and it's all well explained. And so I kind of run you through the UBIT calculator itself, and then if people do sign up to be an investor with me, then I do provide it every time for each new investment going forward.
Sure. So if they head over to wall2main.com, that's where you're going to find that. And I'll make sure to include that link in the show notes.
Yeah.
So with everything that we've been talking about here right now, then what do you think is the more practical way to invest this capital? Like, you have, let's say they've gone through this whole process now. They got the checkbook control. What do they do with it? What would you recommend?
Yeah. So what I honestly recommend what I ended up doing. I'm very happy with I don't really have any regrets with the process that I went through when I established my account. So what I started with actually was private money loans. And so you need to find someone that you trust. But essentially what it is someone is flipping a house and you provide them with a loan. And because this is a purely passive activity, there are none of that UBIT that I was talking about. There's no leverage associated with it. And you just get an interest rate. You just get paid a certain percentage that you establish with the lender. And you can have some points up front, and you can just have the interest come back into your account. And so that's really nice. It's kind of a set it and forget it type of situation. It's extremely passive. But what's really critical about that is you do find an operator who you trust. I happened to bump into a friend who I actually knew. I live in Denver. I bumped into him at a meetup here. I didn't know he was into real estate, and it turns out he was deep into real estate. And him and his childhood friend from kindergarten fix and flip buildings in Boston. And so I was able to look through their portfolio. I was able to kind of I already knew who he was. I knew I trusted him. And so if you find yourself in a position where you know the person and you're happy and comfortable with providing them with, $100,000, $200,000, significant amounts of capital that you might have, then it's a great passive opportunity. If you want a little more control and you kind of want to pick, with a more professional, a larger group of folks, I really like syndications. They're a great opportunity. I personally do multifamily. There's all kinds of syndications. There's self-storage and, commercial, industrial, stuff like that. So those are great opportunities because they're passive. You cannot actively manage a multifamily property. You can't be a general partner in a multifamily property and invest with your retirement account. But the nice thing is you can still be a limited partner. You can just put the money in and see cash flow come into your retirement account whenever distributions come out.
So when you first started out, did you have any issues with some of these syndications with being accredited? Because some of those syndications required being an accredited investor, don't they?
Yeah. So I not so much. I found a group that specifically focused on 506B, which is able to focus on sophisticated investors. I personally am not an accredited investor yet. So it enabled me to kind of get more involved. You do have to do, a little more homework. You need to kind of go to more events and meet more people and see, who's out there who you trust, and then also get to know them and find out about their track record and see what they're looking for. And as you get to know them, you can actually get involved if if you're sophisticated enough to make a clairvoyant decision on if this is a great, investment for you or not, if it matches what your investing goals are. So once you meet that sophisticated level, if you find the right group and you find the right sponsors, it's still the opportunities are just as good as for accredited.
Sure. So let's bring a little realism into this now. How are you doing with your personal investing when it comes to this type of thing? Like, how is it comparing to people dumping money in the stock market? Or I think that's one of the more interesting things, that we just kind of blindly just trust that it's going to do something. This has got a bit more. This is a bit more transparent. You're likely going to know in more detail what's going on.
Yeah. I've been doing a few podcasts lately, and you're the first person who's actually asking this. And I'm going to answer this honestly. When I decided to move everything from retirement accounts, in the stock market into real estate, what I did was, because I had them all in stocks previously, I sold a portfolio. And what I did was I opened up a Yahoo portfolio at the same time, a fake portfolio. And I essentially bought all of the same funds at the same rate that I sold at, so I could keep track of what my gains would have been past then. And since I sold, I'll admit, if I was in stocks, I would have done better. The stock market at this point is pretty detached from the economic picture. Valuations are pretty high compared to their actual earnings. So yes, I'm actually trailing where I would have been in the stocks. I'll be honest, but I'm very happy with where I'm at now because it's in a stable asset class. I don't know if, as stimulus dries up in the next few months, if they can't come to an agreement, who knows if the stock market is going to continue to climb. It's being, in my opinion, essentially propped up by, the Fed pumping money into the economy, which is what they need to do, but it's resulting in some inflated asset values. And so if I hadn't gotten into multifamily, I know my nerves would have been on. I would have been afraid a little more. I would have not had easy sleep at night. Being in an asset class that is a lot easier to kind of go to sleep at night and understand that somebody else, there's a team of people that are working on your investment that you can reach out to at any time and say, hey, I'm kind of concerned about everything that's going on with coronavirus. Are you able to lease up the property? What's going on? You can reach out to those sponsors and you can get a feel for what's going on with your investment. And so, you might have a bit of, what is it called? Buyer's remorse, looking back on what happened. But at the same time, I can't fault myself in the past for making a decision that would have ended up maybe being the wrong one. But because I'm still happy with where I'm at right now. I'm with private money loans. I'm making 15% with multifamily. I'm making between 8 and 15% as well. And I'm happy with those returns. If I can consistently pump those out for the rest of my life, I'm fine with that.
Mm-hmm. Well, I mean, you're the first person that I've run into that would have taken a moment and bought everything in Yahoo just so that you could see how it was going to perform and compare it. I mean, that's some serious forethought. That's pretty awesome.
Yeah, it was a fun little project. I felt really good about myself in March when the stock market collapsed. I said, "Oh, look, I saved myself hundreds of thousands of dollars here." And but at this point now, when things have run away, it's a gut check. It takes a second to kind of take a look back and see what you've accomplished and if you're making the right decisions. And I like to do that as I pivot from one career move to another. I wanted to make sure that I was keeping track and keeping myself honest about if I'm confident about this strategically, but in practice, is it actually paying off?
Mm-hmm. So, I warned you that it was probably going to be about 30 minutes, and I don't want to take up your whole night here. But there's obviously a lot of information and a lot of, we did kind of get into the weeds a bit on some of these topics, but frankly, if people are interested in this, they will likely need more help. Where do they find you? What would be your recommendation for their next steps if this is something they want to pursue?
Yeah. So if you head to my website at walltomain.com, I actually have an entire learning portal where I teach you about passive investing, but I also teach you very much about retirement accounts. And just on a whim the other day, I calculated all of the videos together on the retirement account side. They all add up to just under 30 minutes. So if you can find yourself 30 minutes of time and you run yourself through, I think it's 6 videos, I will get you to a place where you feel very comfortable and safe opening up a self-directed retirement account, and you can then go forward and make any kind of investment that you want. Additionally, on my site, I'm currently offering a free PDF, the top 10 tips and tricks when investing with your self-directed retirement account in multifamily. And in there, I provide all kinds of ways to avoid UBIT, different, kind of maneuvers that you can make, and ways that you can strategically invest with a self-directed account.
Well, I really appreciate your time, Josh, and thanks for bearing with us as we tried to define and understand some of this terminology and how this process all works. I really appreciate it. And I hope you can join us again sometime.
Yeah, absolutely. Would love to. Thanks.
We've put a lot of effort into providing useful content, and if you found value in the show and have any interest in supporting us with a small donation, head over to patreon.com/housedudes.
And if you have any thoughts or questions, shoot us an email at info@housedudes.com. You can also find us on Facebook, Instagram, and Twitter @housedudes. And if you like what you're hearing, head over to iTunes, subscribe, rate, and review the podcast. It really helps other investors out there find the show.
And remember, massive positive impact requires
massive positive action. We'll see you next time. This episode was brought to you by housedudes.com. Do you have time to actively manage flipping and rentals yourself? If so, go for it. If you live in a market that won't cash flow or don't have the time to do all the work, are you just out of luck? If there was a way to participate more passively, would that appeal to you? I'm sure you have questions about how the process works and what to do next. If that's the case, fill out the form on housedudes.com/investors, and we'll reach out to see if you are a good fit for our business. This is first come, first serve, and we will have to stop taking applications when our goals are met. See you at housedudes.com/investors.
I don't like to tell a man what to do with his money, but if you ain't investing in property, then you're dumber than a dummy.
I'm not dumb. I'm smart.
Well, buy property. That's my advice.